Anand Chart has also joined. Ananth, well, what is your sense? We saw money becoming expensive or yields going up by 25 basis yesterday, 30 basis yesterday. Is that it, or do you see the 10-year going towards 7? For the next 6 months, will it remain at these levels?
Morning, Lata. So look, I think the curve will steepen from where we are. Clearly, yesterday's move from accommodative to neutrality was a shock for the system. At the same time, we must remember that there is an overhang of surplus liquidity in the system, which the RBI itself projects will remain for the greater part of the first half of this year. That should keep the short end of the curve supported. So I suspect that if you're at 6.25% of repo rate, market no longer discounting any more rate cuts, and let's assume that we stay static at 6.25, then I guess 50 to 75 basis points premium over the overnight rate for the 10-year does sound reasonable. To that extent, 6.75 to 7% could be expected the 10-year. I do expect some eventual demand to come in even for the longer end of the curve, though, for a couple of reasons. One is, the government supply will stop with tomorrow's last auction. Thereafter, there's no more supply coming through. Plus, when you have so much of liquidity sloshing around, there will be a demand for bonds across the curve.
Anand, we were actually looking at it from the NBFC's angle. So for CPs and those who are raising money through CPs and debentures, is life a little more difficult? Is money more expensive in the next 6 months than it was in the previous 6?
Look, yesterday after the shock announcement, there was a pop-up in all kinds of interest rates, including the short end. A T-bill rate, which was around the 6.1% handle, you would expect that to be in the 6.25, 6.30 handle today. But I think that will subside. As I mentioned, in the lower end, rates will gravitate downwards given the fact that there is this overbearing amount of liquidity in the system. And given that credit offtake is just at 5%, banks will have little avenues to actually deploy this liquidity. So bonds, CPs, CDs, eventually yields will get anchored by this slush of liquidity. So I don't think short-term funding rates will pop up as much as, let's say, the 10-year bond yields will. They will remain anchored maybe 10, 15 basis points higher than where they were yesterday.
All right. Thank you very much, Ananth. Just wanted to gauge the cost. Sorry.
Yeah, I just had one question for Ananth, if we have some time. Ananth, wanted your view quickly on the rupee as well, because, now the yield differential between the developed markets and India has widened quite a bit. So do you see a lot of foreign money coming into the rupee?
That's a great question. Look, I do think rupee will remain on the stronger side now. And in an oblique way, it is helped by yesterday's monetary policy. As you mentioned, interest rate differentials will widen given yesterday's policy stance change. And that means a couple of things. One, in the medium term, we will see FII money coming back into the country, including into debt. External participants will see yesterday's policy as being credible and inflation-oriented, and therefore India being a good bet to eventually bring in some money. Secondly, from a hedging cost perspective, the moment differentials widen, you have exporters who will want to take advantage of the higher premium, and importers who will be loath to pay that kind of cost. It's not a great sign, to be honest, because that leads to unhedged exposures going up in the country. But that is a trend that could play out in the short run.
Okay, Ananth, thanks a lot for your time today.
That's a very